Thank you all so much for being here. Let's start talking tax planning for homeowners and real estate investors. I'm an enrolled agent. Roadmap Tax, we've built it specifically to help real estate agents and real estate investors win the tax game. We're real proud of that. Our agenda today is threefold. We're going to talk about how to buy your primary residence from a tax standpoint, how to get into real estate investing from a tax standpoint, as well as how to get out of it, right? Because in the life of every real estate investor, they come to a certain point where they just want out. How do you do that without having the pain? The tax benefits of buying your primary residence. When you look at your taxes, there's something called a Schedule A itemized deductions. That is the number one tax benefit of owning your own home, because you can now write off your mortgage interest and your state and local taxes. Now, you're going to notice some asterisks here. I'm actually going to cover those asterisks, but it's really interesting to keep in mind that since 2018 tax reform, our standard deduction is really high. Yeah. And it's usually higher than the combination of your charity and your taxes if you don't have a mortgage. That's why a lot of people, as they pay off their primary, once they pay off their home or they've paid the interest way down, principal way down, they no longer itemize because the standard deduction is so high. So let's talk about those asterisks really quick because they're very important. First is the $750,000 acquisition indebtedness limit. What that means is you buy a home, up to $750,000 of mortgage debt can be, how would you say, can be written off, but anything over that can't be. And we'll go into an example in a second. Also, 2025 taxes, tax reform, the one big beautiful bill, we can now write off up to $40,000 of state and local taxes subject to your total income. So let's go back into that more. The $750,000 acquisition indebtedness limit limits the deductibility of mortgage interest on your primary residence. Specifically, you're going to have to look at the total purchase price and then the total loan amount and compare the loan to the purchase price. So in other words, if you had somebody that bought a $750,000 property and they had a $750,000 loan, all of the mortgage interest would be tax deductible. But if you had somebody that bought a $2 million house with a $1.5 million loan, only 50% of the mortgage interest is tax deductible. Why? Because it's only up to $750. The additional $750 is not tax deductible. So sometimes, when you're looking at should you put a bigger down payment or a smaller down payment on these $1 million plus homes, you really should take a look at this. If it's your primary residence, you can only deduct mortgage interest based on a $750,000 mortgage. Anything over that just gets offset, really, or not deducted. Going over to talk about SALT, state and local taxes. If you make less than $500,000 a year and you're either single or married, we can now write off $40,000, up to $40,000 as an itemized state and local tax deduction. It's huge, right? For the last several years, it's only been $10,000. Now, of course, if you make over $600,000, it's back to 10. And between 5 and 6, it goes down. But for the vast majority of people, they now can write off up to $40,000 of state and local taxes, mortgage interest up to $750, and let's take a look at some examples. So in each one of these examples, we're going to assume $200,000 of W-2 income and a $750,000 property with 100% VA mortgage. No funding fee, 100% VA. Okay, so just some easy things here. Southern California, 1.5 or 1.25% property taxes. You're going to have on a 6.5% 30-year fixed mortgage, $4,700 a month as a payment, principal and interest. And in an entire year, that first year, you'll have $48,000 of interest. So key numbers here, $750,000 mortgage indebtedness, $9,300 of property taxes, $48,000 of interest. Let's see how, if they didn't buy a house, let's see what their taxes would look like. So this single person, standard deduction of $15,000. Okay, 200 minus 15 is 184, and that $184,000 yields $37,000 in IRS taxes and almost $15,000 in California taxes, almost $52,000 total in federal and state taxes. Same person. Now we're going over here to buying their primary residence. Remember, we're going to be able to write off the $9,300 of property taxes. They're going to have, instead of $14,000 of income taxes, they're going to have $9,800 of income taxes. That's just the tax savings on the mortgage interest. So we'll be able to write that off. And then we're going to write off the mortgage interest. So instead of having $184,000 of taxable income, they're at $132,000. And at the end of the day, they're at $34,000 of total taxes. If you compare that, if you compare it from being a renter to a buyer, to an owner of your primary residence, so almost $1,500 a month as a difference from tax standpoint. Now, if you ask me personally, owning your primary residence, the reasons why the tax savings would be third. The first reason is that pride of ownership, of being able to own something that you can do whatever you want in your own home. You don't have to ask your landlord. The second thing would be the opportunity to build equity long term. But that third option of saving money in taxes is still significant. Married people, same income, $200,000, standard deduction is a little higher. You're going to notice that they pay less income taxes than somebody that'd be single, just because their married brackets are a little bit easier. I like it, Michael Garner. We are going to talk about rental properties in the next section. And no, the same rules do not apply in your rental. In fact, a rental property is substantially better from a tax standpoint than a primary residence. If, on the other end, this same married person went and bought the same house, we're going to write off the same amount of property taxes, same amount of mortgage interest. You're going to notice the California taxes are lower because the mortgage interest made it lower. And at the end of the day, what do we have? We're saving almost $1,000 a month in income taxes by owning that $750,000 home. Okay. As a recap of this section, what we've covered is itemizing your taxes on your primary residence. You got state and local taxes up to $40,000 for most people, mortgage interest deduction up to $750,000 of acquisition indebtedness. All right, let's go ahead and move on to the second phase. And this is Michael Garner's question. Hey man, what's the difference between your primary residence and your rental property? And the answer is outstanding. Like, it's tremendous. Look at this. Your primary home, you can only write off your up to $750 and the state and local taxes up to $40. I don't want to say it's unlimited on rental properties, but there's no specific caps. If you can answer the question of, the acronym is CORN, customary, ordinary, reasonable, or necessary. Think about all the things you need to do to manage your rental property. You're cleaning it, you're paying HOA fees, insurance, legal and professional fees, management fees. Mortgage interest is unlimited. Okay, let's talk about that for a second. If we go big and we buy, a $10 million apartment, the mortgage on that's going to be way more than $750,000. Yet there is no limit on our ability to deduct that mortgage interest on that $10 million apartment, because it's necessary to get that mortgage in order to have the rental property. And Simone, great question. So is $750 lifetime or per home? It's per home, but you can only have one primary residence at the same time. So and again, it's acquisition indebtedness. It gets murky once you've owned a property and then you refinance it, because refinance equity on your primary residence is not tax deductible. It's only on the acquisition indebtedness. Okay. Same thing with property taxes. That $10 million apartment, it's going to have more than $40,000 a year in property taxes. 100% of the property taxes would be written off. And again, it doesn't say this here specifically, but I want to point out your primary residence is written off on your Schedule A itemized deduction. That's your personal itemized deductions. Rental properties, generally speaking, are treated as a rental business on a Schedule E. And so those limitations that are inherent to your primary don't apply in the rental properties. It's really powerful. One other thing that you get on a rental property that you do not get on your primary is depreciation. IRS Pub 946 says depreciation is an allowance for the wear and tear, deterioration, or obsolescence of property. To compress that, what is it? It's just a wear and tear allowance. Okay. And Krista says, we were thinking about buying a rental since our primary residence will be paid off soon. What do you think? So long as it cash flows, it's a great idea. And by the way, we can refinance a primary residence and utilize the proceeds to acquire a rental property and then assign that to the acquisition of the rental. That is absolutely possible. And a lot of people have done that over the years. One of the other things that you get with depreciation is bonus depreciation. Now, to understand that, what does that mean? That just means, like, if whatever asset it is, okay, if it has a 5-year useful life, the IRS lets you depreciate over 5 years. Real estate by itself is 27 and a half. But bonus depreciation allows us to take all of the depreciation ahead of time, okay? There's some limitations to it. Specifically, you can't deduct structures, but let's go into it in depth here. So when it comes to depreciation of real estate, we have land and we have improvements, okay? Also called additions. But the default setting for real estate is those additions are 27 and a half years. If you had a $1.5 million property, $500,000 allocated to land, $1 million to improvements, you could write off $36,000 a year just in depreciation. So what does that $36,000 offset? It offsets $36,000 of rent, right? So you can think about it. You could charge somebody $3,000 a month to rent it. The depreciation is going to absorb all of that income, and you wouldn't have any taxable income, even though you really did collect $36,000. Okay. Now, again, when it comes to real estate, the default setting is 27 and a half years. So like the sticks and stones of your property, the IRS will say that needs to be depreciated over 27 and a half years. But the fencing, all the land improvements, sidewalks, those non-structural improvements have 5-year, 7-year, 10-year, 15-year life expectancies. And so there's something called a cost segregation study. We provide that as a service at Roadmap Tax. Cost segregation study is an engineering study to separate the different components, okay? And Shannon says, can you address selling and then buying an equal value primary property, especially regarding capital gains? Absolutely, I can, Shannon. I'm going to finish the thought up on depreciation. We're going to come back to that because you're bringing up a very interesting point. So cost segregation study, we're trying to split the property into its component parts, the structure, foundation, the walls, and the non-structural components like the shrubs and the fences, whatever else. Generally speaking, we find that about 20% of a property value is in non-structural additions. So in this example, this is that same $1.5 million property we had before. We're still allocating $500,000 to land, but you're going to notice 700 is to structural and 300 is to non-structural. They're all additions, right? But the structural components are what need to be depreciated over 27 and a half years. The non-structural components, that entire $300,000, so long as you put the property in service January 20th of 2025 or later, we can write off the entirety of that depreciation allowance in the first year, okay? In the second year, you don't get it again. The second year, it's down to $25,000, right? If you didn't do this, it'd be $36,000. But now you potentially can take $325,000 of depreciation against other income. Now, whether or not you can apply that has a lot to do with whether or not you have other passive income, or if you're a real estate professional, or some other things. And I'll get to that in a second. Okay. But let's actually talk about Shannon's question real quick, because she's bringing up a really good point that kind of confuses two tax requirements, one from a long time ago and one from current. Okay. So when you sell and buy your primary residence, it used to be a long time ago, in the 90s before, there was something called a 1034 exchange, where you could exchange your primary residence for a property of equal or lesser value, not paying any capital gains taxes. That is no longer the case. That's now covered by Section 121, which we're going to cover in depth in the next segment. And the other part of this question that comes up regularly, actually two parts, is the 1031. A 1031 exchange in real estate, this is only for rentals. You've got to be equal or greater value, right, sales price, or equal or greater debt. And it's both at the same time. Okay, people get in trouble with where they take the proceeds and they buy a more expensive property, but then they don't have sufficient debt as a carryover. And then the last one, the third component where this gets confused, is Prop 19 in California, where you can sell your primary and you can transfer the property tax basis to a new property. If it's the same or less, there's no change. If it's the same or greater, you just pay the difference in your property taxes. But technically, that's not a capital gain, right? We're just covering right now cost segregation studies and the power of utilizing bonus depreciation. And this is where it gets worse, because there's something called passive activity loss limitations. So by default, rentals are passive. And what that means is your earned income, your W-2 earned active income, generally can't be offset by passive losses. So you've got that $325,000 depreciation loss, and you make $325,000 W-2. Unfortunately, there's something called passive activity loss limits and suspended losses. Since you make over $150,000, you can't take it at all. And it just accumulates until you have passive income. So how can you overcome that? One strategy is by having passive income for the passive loss to offset. Let's say that you have an S corporation, it's your active business, but your spouse is a partner. Your spouse can be a passive owner. And so if your S corp earns $200,000 and you're 50-50 there, $100,000 of that income can pass through to your spouse as passive income, and that would absorb $100,000 of passive losses on your real estate. That's a way. Another way, and this, Simone was alluding to this earlier, become a real estate professional. We'll talk about that, and then we'll also talk about the 7-day rule. Real estate professionals have no limits on their passive losses. The only cap there is the $256,000 single, $512,000 married excess business loss limits. Aside from that, you don't have to worry about passive losses on your property, but you do have some it's a high bar, right? To become a real estate professional, you have to demonstrate at least 50% of your working hours are in real estate, and 750 of those hours are managing your properties. Now, you can aggregate all of your properties to treat them like one endeavor, but in my experience, this really only works for two types of people: full-time real estate agents and tradespeople. So if you're carpenter, plumber, electrician, HVAC, if you're really working in construction, it's pretty easy to be considered a real estate professional. If you're a W-2 salesperson outside of real estate and you've got several rentals, the odds are you're not going to be able to qualify as a real estate professional. But here's something you can do. Okay, this is called the 7-day rule. I like to call it the bed and breakfast rule because before Airbnb, this is what a bed and breakfast was, like Newhart, the TV show. If the average guest stay is 7 days or less, and you provide guest services like maid service, cleaning service, linens, etc., then we can treat this as a Schedule C business, and your efforts in managing it, which could be as little as 100 hours a year or 2 hours a week. Think about this. You've got an Airbnb. You own a property. You have it as an Airbnb, and you spend 2 hours a week booking guests. We can treat this under the 7-day rule, and now you've got that $325,000 of losses that can offset, if you're married, $325,000 of income. Okay, this is huge. Now, Jesse, I don't. My property is a long-term rental. It gets dicey, right? It gets dicey if you're not qualifying for the 7-day rule. Then we need to either figure out if you qualify as a real estate professional, or we figure out, do you have other passive income that can absorb? They're all opportunities for effective planning. Okay. Yeah, absolutely, Shannon. I'm gonna go off the presentation here really quick because Shannon's bringing up something that it happens all the time. So let's just address it. So we're looking at Prop 19, okay? And you're noticing here boe.ca.gov/Prop 19. Proposition 19 came into effect a couple of years ago, and it consolidated a lot of old props, like 58 and 193, where you could pass on your primary residence to your children or grandchildren, and 60 and 90 and 110. But 60 and 90 is the one we would see all the time, where you were trying to transfer the property tax basis of your primary residence. To Shannon's point, this is the one that most people have the most questions on, okay? On the left column, we have the old rules. On the right, we have the new rules under Prop 19, okay? The old rules and the new ones, you still have 2 years to buy or build, 2 years from the time you sell your primary residence. Prop 19 is a huge benefit now because it's anywhere in California. In the old days, there were several counties in Northern California that didn't let the fine people of Southern California exchange properties. Don't know how that was possible. That's how it was. That is no longer the case. This is statewide. The second aspect of it is you're going to notice the old rules were equal or lesser value, 100% in the year of the sale, 105% in the first year, and 110% in the next year. And that just means that if you sold a $500,000 property and bought a $500,000 property right away, you could transfer that Prop 13 tax base, right? You bought the house in 1970 for $25,000 and you sold it in 2020 for $525,000. $500,000 gain. IRS is going to say that that's tax free. But now you've got a $500,000 house that you're paying taxes on from $25,000. If you went and you bought a new $500,000 house, it'd be very expensive. But Prop 60 and 90 let you transfer it. Prop 19 also lets you transfer it exactly like Prop 60 and 90 did, but now you get to go up. So same exact scenario, your $25,000 property is now worth $525,000. You buy $1,025,000 property. The first $500,000 of the new property won't be reassessed. You'll just pay new taxes, new property taxes on the difference between $1,025,000 and $525,000. At the end of the day, you're not being penalized for. It's interesting. You may be downsizing. You may be going from a 2-level home to a 1-level home, but because the prices are so much more expensive, you're actually going up in value as you downsize. Old rules, you can only do it once. Now you can do this 3 times. and this is anything after April 1st of 2021, I really believe if we look at Prop 19, Prop 19 is really good for people that are 55 years and older. Like everything's good. However, it comes at the cost that if you're trying to pass on your properties to your kids, your grandkids, now, unless it's their primary residence, and it typically is not going to be, but unless it's your residence and their residence, it's going to be reassessed. And that's where any property tax savings for the 55 plus crowd, that's going to be absorbed by additional property taxes on the inheritance crowd. All right, Shannon, good question there. Let's recap the section now on becoming a real estate investor. Okay, kind of like when Michael Garner asked, how does this compare to have a primary residence? Being a real estate investor gives you substantially more opportunity to write off expenses, okay? The key is you can deduct all necessary and reasonable expenses against your rental income. Of course, you've got to put the property in service and you got to have rental income, right? You have to hold it out as a rental. Depreciation and cost segregation studies are huge. They can lead to massive tax losses, but you got to be careful that you have income to offset it. I did not give this as an example, but I just for most of you, I mean, I know a lot of the people in the audience right now, if you are a full-time, all the time real estate agent, real estate professional, real estate broker, and you have your commission income over here, typically run through your S Corp, and you've got your rental property over here, and you do that cost segregation, you can use those rental losses to offset and even wipe out your S Corp profits. Very powerful. But if you're not a real estate professional, if you're not a contractor, or a carpenter, or plumber, or electrician, or a real estate agent, then the odds are you're not going to be able to use losses in your real estate rentals against your W-2 income. And the exception to that is the 7-day rule. This is huge. This is because the 7-day rule means you're treating your rental property like an active business, and active business losses can offset W-2 income. So if you're in the market of whether or not you should buy a property and Airbnb it or buy it and make it a long-term rental, it depends on what you want to do. Is it going to cash flow all the time? Are you going to be able to do a cost segregation and get accelerated depreciation? So there's some math that needs to go into it, but that's where tax planning comes in, right? All right, guys. So now that you bought it and you love it and you've held on to it for a while, now let's talk about selling it. Okay. Shane Curry says, owning a design architecture firm qualify me as a real estate professional. And I'm going to say probably, okay? And well, Jesse, why don't you just say yes? All right. Everybody that's on this webinar, I'm going to send you an email with the following, what Shane just asked for. And so I'm looking at my other screen, but I'm going to pull this up in 30 seconds. This is a chat GPT that I made a year or two ago. Here it is. This is the real estate professional checklist. Okay. Now, in this real estate professional, in this checklist, we've got 2 pages. The first page is what we talked about earlier. Hey, to be a real estate professional, test 1, it's 50% of your time in real estate. Step 2, 750 hours in real estate activities. Okay. But page 2 talks about what 469 C7C defines as a real estate trade: development, redevelopment, construction, acquisition, conversion, rental, leasing, management, brokerage. Okay, Shane, I would think that as an architect, that you would be in the real estate development, redevelopment, or construction phases. So to that end, especially as the owner of a firm that does that, I would say that you would qualify as a real estate professional. Okay. That was a great question. So again, guys, I'm going to give you this I'm going to also give you, this is old timey. Nick Emerson, he's a real estate agent. He asked me to do this like almost 15 years ago. But this is literally a side-by-side comparison between being an owner of a primary residence and being a real estate investor. And what you're going to see here, very similar to what the PowerPoint showed, real estate taxes, mortgage interest, and then put an asterisk there, subject to the limitations, $40,000 state and local, and $750,000 mortgage indebtedness. All of these over here, like we covered right out of IRS Pub 527, anything you need to do to run your real estate business, it's right there. It's pretty awesome, okay? So now let's talk about selling our properties. Okay, there's three major sections I want us to cover. And by the way, section 121 is the one that most people get wrong. And this is a huge tax planning opportunity here. So let's dive into that. So most people know section 121 is the $250,000, $500,000 exclusion. You got to live there and own the property for 2 years, right? 2 years owner, 2 years residence. Really easy. But there's also a lot of exemptions, work-related and health-related. If you have to move 50 miles or more from work, and because of your work, because you got a new job, or you have to move to take care of yourself or someone you love, we can utilize that as an exemption to the 2-year rule. Also, let's talk about unforeseeable events and the 2008 rule changes, which unbelievably people still don't know about, and it's been a long time, all right? So unforeseeable events, what are that? Your spouse dying, that's bad. Getting a divorce, having twins, becoming eligible for unemployment, and then verbatim here out of IRS 523, it's becoming unable because of a change of employment status or basic living expenses that you can't meet your needs, right? And if that's the case, then you qualify for unforeseeable events. Let's figure out how this works. So again, you had to move 50 miles, you had to move away 50 miles or more for work, to take care of somebody, or because you either got a divorce or twins or you're unemployed. Let's take a look at any of those scenarios. Here's an example. They bought the house in March 31st of 24 for $700,000. Primary residence, easy. 1 year later, April 1st, April Fool's Day, oops, you lose your job. The property is worth $800,000. You got a $100,000 gain, but you haven't been there yet 2 years. In fact, you've only been there 12 months of 24. No worries. Because of the unforeseeable event exemption, we're going to take 12 months, divide that into 24 months because 2 years is 24 months. That's 50%. And we're going to multiply that times the $250,000 exemption. And we're going to find that this person still has $125,000 of protection, completely erases the $100,000 capital gain. They can sell, no taxes due, God bless America. Okay? The flip side, though, is worse. So let's talk about that. Don't move in for 2 years. Don't do it. If it's a rental, you bought your property however many years ago, you rented out the whole time, and then you're going to move into it because you think you're going to save $500,000. Don't do it. Here's the example. They bought the house in 2015 for $400,000. They never lived in it. They always had it as a rental. In 2023, they're like, man, we're going to sell this in a couple of years. Let's move in, make it our primary. Then we can sell it in 2 years and wipe out all of our taxes. And that's not the case. Because in January 1st, 2009, a new rule came up, and it brings the concept of non-qualified use. So what you have to do is you have to say, okay, I own the property for 10 years. I had it as a rental for 8 years. So 80% of the time, it was not my primary residence. You have a $500,000 gain. So 80% of the gain, or $400,000, is not eligible for Section 121 exclusion. You can only protect $100,000. and heaven forbid you're the real estate agent that told the person to move back in for 2 years and sell it, because the taxes due on that $400,000 are like $120,000. Just a recipe for unhappiness. So, am I saying that you can never sell a rental? I'm not saying that. I'm saying let's take a look at a different strategy. All right, here we go. 1031 exchange strategy. My personal opinion, I think this is the most powerful wealth accumulation strategy that exists. It's a trade-up strategy, right? Equal or greater value, equal or greater debt. You can defer the gains indefinitely. When you die, you get a step up in basis, your kids sell it tax-free, everything's good. What's hard about it? It's the fact that you only have 45 days from close of escrow to identify the new property, and only 180 days to close on the new property. And with low inventory and high interest rates, sometimes people find it's very difficult to find that correct replacement property. One solution that I've seen clients do is 1031 out of state. And if you're a California real estate investor, let's talk about something real quick. The Franchise Tax Board, California's taxing agency, this is called FTB Form 3840. Technically, it's an information filing form for people that 1031 out of California to anywhere else. But the reality of it is it connects you with California forever, or until you die, you donate the new property to charity, or you decide to pay taxes on it. And I know you guys got to be out there thinking, Jesse, that's ridiculous. That's not true. Don't take my word from it. Don't take my word for it. This is a screenshot of the FTB's website. And it says you must continue to file Form FTB 3840 as long as you defer the gain, i.e. as long as you own it. If you exchange the out-of-state property with another out-of-state, so if you do another exchange, you still got to keep doing it, okay? Until you report and pay taxes on it, or until the owner dies, or you donate it for charity. The reason I have this red box here is that this is the worst sneaky thing that California does. You'll 1031 exchange your property out of state, and then you won't file the 3840. 3 years from now, California will send a notice of proposed assessment that you won't get because it won't be to your new address. And because you don't respond to that notice in a timely manner, they will then assess the property. They will assess the taxes on that 1031 exchange. And it's outrageous, okay? So my word to all you real estate investors out there, if you are going to do a 1031 exchange, that's a powerful strategy. But if you're going out of state, you got to file 3840 forever. And Gloria says, we're here in California and sold a property last year in Florida. Did not do an exchange. We are not looking forward to the taxes. Oh, Gloria, that's an interesting conundrum you got there, because Florida doesn't tax. Florida won't tax. They don't have income taxes in Florida. But it really ultimately depends on how much of a gain did you have. Are you going to have depreciation recapture? There's a lot of littles. Now, one thing that this presentation doesn't cover, because in all honesty, I really don't love the strategy, but Gloria, if you sold that property in Florida within the last 6 months, you can still do an opportunity zone now. You have 180 days from the time you sell the property to reinvest the gains. The issue is that you're still going to pay taxes on the sale within 5 years, so it doesn't get completely deferred. But I think an opportunity zone strategy, if you sold within the last 6 months, it'd have to be October, November, December of last year. It's at least something, okay? All right, so what do you do when you say, I'm tired of toilets, tenants, and trash? My God, I just want to sell my rental, but I'll lose too much in taxes, okay? In this scenario, I'm going to say that a 1031 exchange won't work. Why? Because you don't want to mess with the tenants, but you're done. You want fire and fury. You want to stop being a landlord. You want to not pay deferred maintenance. So let's talk about the old section 453. This was really popular in the 80s when interest rates were really high. Several different names: installment sales, seller financing. But before we say no to it, let's dive into it, because it's a powerful strategy. It can be used for your primary residence, your rental properties, even businesses. Okay. And let's compare what it looks like to a traditional sale. A regular sale, regular traditional sale, you've got a seller, you got a buyer, you got escrow. The seller's bringing the deed and the buyer's bringing the money. And through escrow, the seller now has the money and the buyer has the deed. Everybody goes off happy. Okay. In a traditional installment sale, the seller's still bringing the deed and the buyer is bringing some money, but really they're going to sign a note that says that they're going to make payments to the seller. Now, just looking at this, our new next best friend is our buyer, but there's some huge risks here, right? You got the risk of default. What if they don't pay you? Then you got to foreclose on the property, and it's probably beat up, and you got to rehab it. It's a hassle. And then you got prepayment. If we're trying to stretch our payments over time, because you only pay taxes on the money you receive. So if we've got a big gain and we're stretching it out over time, we're trying to maybe get in that lower tax bracket. But if they prepay you because interest rates go down, that's a risk, right? So how do we get the reward? How do we get the lower long-term capital gains brackets, which are as low as 0, and continue to get tax deferral while mitigating the risk of default and prepayment? Right? We've got a solution. And by the way, long-term capital gains taxes, 0% up to $98,900 married. Add $30,000 on top of that for the standard deduction. If you didn't have any other income coming in, you can literally earn $125,000 a year in tax-free long-term capital gains. Okay, but going back to the installment picture, all right, this is the picture, right? You bring your deed to escrow, they give a note, and they make payments to you. The structured installment sale is a special type of Section 453 where the buyer brings money to escrow and we assign the note to a trust company that backs the payments with an insurance carrier. So what do you have here? You've got a note, which means we can spread the payments and the taxes over time. And you've got literally money in the bank, money that's insured and payments that are guaranteed for the term of the note. Okay. So let's look at this. This could be a rental property. This could be a primary residence. You buy the house for $500,000, Section 121. That's $1 million basis. You're selling it for $2 million. You still got $1 million gain. Okay. If you just pay taxes on this, IRS is 20%. Net investment income tax is $38,000. California wants their cut. Would you pay $371,000 on $1 million gain? Yeah, actually you would if you didn't have any planning, because this is all legit. So let's figure out how to save you $371,000. Okay. This is a structured installment sale on a 20-year note. Okay. Do you notice here 200 or 2 million versus 1 million? Okay. Your basis is $1 million, your gain's $1 million. So 50% of your sales price is considered taxable gain. Okay. So that's called a gross percentage, a gross profit percentage. Sell the property for $2 million, no taxes due. The note's $2 million. Okay. Over 20 years, that's $100,000 a year of income. But at 50%, only $50,000 is taxable. Remember, the long-term capital gain bracket married $98,000. And so now instead of paying that $371,000, you're getting $100,000 a year of income and paying no taxes. God bless America. Okay. All right. Recap on the section here. We've talked 121. If you've got a rental property, it's been a rental a while, don't move back into it and sell it. Either look at the 1031 or look at a 453 structured installment sale. 1031 is a powerful accumulation strategy. 453 is a great way to get rid of toilets, tenants, and trash and get income off of that property without the headache of maintenance. And it's also good for your primary residence. Kind of big recap of the whole workshop tonight. We talked about the tax benefits of buying your primary residence, being able to write off mortgage interest up to $750,000 of mortgage acquisition indebtedness, the new $40,000 SALT, state and local tax deduction, that's pretty nice. Benefits of real estate investing, unlimited deductions, although that's limited, unlimited deductions limited by whether it's a passive activity or not, whether or not you have a 7-day rental, meaning an Airbnb, 7-day or less, or if you qualify as a real estate professional. And then we talked about the various exit strategies for your primary residence and your rental properties. If you need any help, roadmaptax.com, client care Roadmap Tax. We're here. We're ready to help you and serve you. If you look at our website, roadmaptax.com, you click the schedule an appointment button. You can schedule tax planning services or tax preparation services. Of course, if you're on subscription, just email Rachel or your tax advisor. We'll get you on the calendar. Guys, hey, thanks so much for making this workshop so much more enjoyable. I really appreciate the participation. And thank you everybody for joining. I really appreciate it. We'll try to do these more often. And with that, thank you so much for attending and have a great night. Bye now.